Hello everyone, welcome back to the channel. Today we're doing the second part of the things you need to bring to your tax preparer. The first one was income types, this one's expenses. Those are the two main things you need to worry about. So, start off, this is for individuals. This is your Schedule A. So, you have two different types of deductions. You have your standard deduction and your itemized deduction. After the 2018 tax changes, almost nobody uses the itemizable deduction because the standard deduction is so high. But in 2024, those changes roll out, so this will be relevant in the future. What is an itemizable deduction? It's basically things that you use in your day-to-day living as an individual that the government doesn't want you to pay tax on those expenses. So the top line here, as you can see, is medical and dental expenses. There is a floor, so if you don't use so much, then you don't get to deduct any. For example, if you make $100,000, you have to spend $7,500 of medical expenses before you can deduct any of the medical expenses beyond that. Don't worry about that. That's something your preparer will explain to you whenever you bring them your taxes. Next, you get taxes you paid. The cool thing about this is most tax softwares actually allocate a percentage of your estimated sales tax based on your income bracket as well. So that's just a bonus taxes. And then you get to deduct state and local taxes, as you can see here, and any real estate taxes you paid, so your property taxes. And then you also get to deduct what they call personal property taxes. So that's like, taxes for your car or for a boat or an RV or, individual items that you have. So the estate taxes are for your house or for real estate, and then personal property taxes are for your personal items. Next, you have interest you paid. This is mainly for your home mortgage. You don't get to deduct interest you paid on a car loan, unfortunately. I'm really not sure why. It's just one of those things that the government decided at some point that people that have a car loan shouldn't get a tax advantage for that. But any home mortgage or refinancing of any other asset, for the most part, you get to deduct those the amount of interest you paid during that year, and all this stuff. You'll get a 1098-T for your home mortgage interest. Taxes you paid, you'll typically get some form from your state or local government, and then you'll get the receipt from where you paid your property taxes. Medical and dental expenses can sometimes be a little more complicated, but a lot of the times you just kind of estimate based on actual receipts you still have and stuff, so it's not too bad. Gifts to charity, some of this can be a little complicated, but basically, unless you're donating like over 60% of your income, you get to deduct any cash receipt donations to charity. Anything, you can also deduct real property transactions, so if you donate clothes or you donate property or a car to an organization, you get to deduct a percentage of that. It's 30% for real property, but I wouldn't worry about that too much. Basically, anytime you donate anything, they'll give you a receipt for that. Just bring that to your preparer. That's a general idea. Casualty and theft losses. This one's very, very rare. I've never done a tax return that I've actually had to deduct the... I take that back. I've done one. Basically, this is if somebody, steals... you get your house robbed and you lose a bunch of valuables, you get the deduction for it. You have to get it appraised. Typically, your insurance will give you an appraisal value, and whatever they don't reimburse you for, you can apply it here. The other itemizable deductions is pretty much completely gone after the 2018 tax cuts. They still have it on the Schedule A because after 2024, whenever the 2018 tax cuts roll out, these will be back. But I wouldn't worry about these right now. So that's for your individual. I know that that's a lot, but the general things you need to take into account for bringing expenses to your tax preparer: medical and dental. You need to bring any receipts you have, any extra interest payments you have, or not interest, any extra insurance payments you have, that kind of thing. Taxes, the state and local taxes, you'll get a receipt whenever you pay them. Same thing with your estate taxes and your personal property taxes. You get a receipt for all that. Bring all of it. There is a limit of $10,000 for married filing joint or $5,000 for single filing. So you can only deduct so much of that. The interest you paid, there's no limitation. So, yeah. So, if you have a large mortgage payment and you've got a bunch of rental property, you get to deduct all the interest you paid on all that. Gifts to charity, bring all receipts you brought. I've never ran into a situation where somebody donated more than they could deduct. So, that's a general idea for the Schedule A. Now, this is, if you're an individual at this point, this is probably where you can stop for the most part, unless you have a side hustle or a farm or rental property. Your expenses, this is part 2. And I put these all in the same category. They're not all the exact same. This is for the Schedule C. This is what this picture is. The Schedule E and the F are very similar. The Schedule F obviously focuses more on typical farm expenses. But then all of these have the other category, which is other expenses over here, and you can break down anything. So the general rule for Schedule E or Schedule C, E, and F is anything that is a reasonable business expense you can deduct. So, you have a farm, you bought cows, that's an expense, right? You have a farm, you bought feed, that's an expense. You have a farm and you bought a, I don't know, super fancy camper so that you can go to some horse show or something. That might not be fully deductible, right? You see what I'm saying? So if it's reasonable and needed for whatever you're doing, then you can deduct it, right? Let's say you got a small business with, let's say, $1 million of revenue a year. You probably aren't going to be able to deduct a Lamborghini that you bought for your personal use. You know what I mean? But anything that you actually used in the production of that income, you get to deduct. That's a general idea here. Obviously, you're going to need to go to a preparer for more information on all this and any specific things that you have questions about. This channel is just for very broad overviews. Schedule D, this one, a lot of individuals are actually going to have. I don't know why I said you could leave, but Schedule D, this is for your capital gains. So any stock transactions, any disposal of other assets held either short-term or long-term. So land's a pretty popular one. We have a couple of clients that buy and sell land almost like stock. This goes on here, and I included the 8949 because that's where the actual input sheet for the Schedule D is. You don't really need to worry about that, but I just put it in there. This is pretty straightforward. Basically, whatever you paid for the asset is your cost. Whatever you got for your asset are your proceeds. I hope y'all can read this in the slide, but whatever you paid is the cost. Whatever you got are the proceeds. You get to take adjustments. So for most brokerages, charge a small percentage. You take the adjustments and you add it to the cost. And then from that, you then take the proceeds minus the aggregate of these two, and you get your net gain or loss. One thing I will say is you pretty much always want to hold whatever asset you have for longer than a year. You get significantly preferential tax rates if you hold something for longer than a year. It's called long-term capital gains. It's a flat 15% right now versus short-term capital gains get treated kind of like ordinary income. So it's a step basis. And if anybody has any questions about the step basis and how taxes are actually treated, I might do a video about that about that shortly. So if you're interested in that, drop it down in the comment section. But this one's pretty simple. Like I said, it's just costs plus adjustments minus proceeds, basically. And that whatever the difference is your gain or your loss. So I know this is short, but I hope it helps. I know that I'm sure there's questions about this one. It would take me an hour to break down more of this stuff specifically and really give you real examples of all this information. And if y'all would like to see, individual breakdowns of all these things, then I can do that as well, of course. But like I said, this channel is more tailored towards large overviews. So drop any questions you have down in the comments or email me directly. I'm always willing to help, and thank you.